Today's earnings featured an e-commerce giant buying up local vet clinics strictly to hack its digital subscriber pipeline.
And we saw a major tech hyperscaler effectively forcing clients to physically bring their own hardware to the data center just to get a spot in line.
Digital growth has officially hit a wall.
It is a wall of extreme physical acquisition costs.
This window closing June 10th really shows what happens when software platforms actually have to pay for the concrete.
Yeah, exactly. So looking at Oracle and CHWY today, they both capture this perfectly. Let's start with Oracle. They announced a massive $638 billion in forward orders. That sounds incredible, but the market punished the stock down 12% anyway.
Because standing up AI data centers right now cost an absolute fortune. Oracle is staring down a $70 billion infrastructure bill. The energy requirement is so intense, they are buying gigawatts of independent fuel cells just to dodge local utility grid limits.
Which totally crushes their near-term gross profit margins, but this is where the customer leverage shifts. They are actually making their corporate clients shoulder the burden.
Right, the bring your own hardware model. Yeah, a massive chunk of that backlog is from clients prepaying heavily or literally handing Oracle their own GPUs just to secure server space.
It behaves much more like heavy capital-intensive manufacturing right now than high-margin cloud computing. The physical bottleneck is just that tight, and we saw a very similar shift toward physical space with CHWY.
Completely different industry, but the same theme. CHWY is facing a tapped-out consumer who is dropping discretionary treats, so they are rapidly expanding physical brick-and-mortar vet locations.
Because online customer acquisition is basically saturated. They realized roughly 40% of the animals walking into these local clinics are entirely new to their network.
Which instantly translates into around $900 a year in locked-in online spending. So renting local real estate is essentially their most powerful digital marketing pipeline.
And that subscription loop is incredibly resilient. Over 84% of CHWY's revenue is still generated automatically by their recurring auto-ship program. Down about 7% on the stock today, though, because management had to lower forward guidance.
Right, consumers are preserving base food orders but cutting out the premium upside. The operational loops for both Oracle and CHWY actually look great, but the sell-offs were purely about the harsh reality of physical growth.
Exactly. Going forward, watch Oracle's gross margins to see if those hardware costs permanently depress profitability, and watch CHWY's operational costs as they try to scale brick and mortar.
The individual company episodes in the feed hold the complete analysis, pulling apart how these physical expansions are reshaping the balance sheet. Catch you next time.